Money controls much of modern life, yet many people don't fully understand how the financial system around them actually works. Concepts like taxes, banks, interest, inflation, credit scores, and investing shape everyday financial decisions. When you understand how these pieces fit together, money stops feeling mysterious and starts becoming a tool you can use. Let's start with taxes. Imagine working hard all month at your job and expecting to receive $2,000 in pay. When the money arrives, your bank account shows only $1,456. The rest disappeared before it even reached you. If you check the pay stub, you'll see deductions like federal income tax, state tax, Social Security, and Medicare. This is the routine process of taxation. Taxes are essentially the price people pay to maintain a functioning society. Governments use tax revenue to build roads, run public schools, maintain safety regulations, and fund large national programs. Sometimes that includes things you directly use, and sometimes things you may never see, like defense spending or international programs. There are several different types of taxes. Income tax applies to the money you earn from work. Sales tax applies to money you spend when buying goods and services. Capital gains tax applies to profits made from investments. In addition, most workers contribute to Social Security and Medicare through payroll taxes. Social Security works like a forced retirement savings system. Workers contribute throughout their careers, and when they retire, they receive payments back over time. Medicare, on the other hand, is a health insurance program primarily for older adults and people with serious medical conditions. Then comes the complicated part, filing taxes. In many places, the government already knows how much tax you owe, yet you're required to calculate and submit it yourself. If your estimate is correct, everything proceeds normally. If you make a mistake, penalties can follow. Some people pay taxes quarterly, while others file once a year. And of course, there are those who avoid paying entirely and eventually face legal consequences. Despite their frustrations, taxes also correlate with stronger infrastructure and higher living standards in many countries. Now, let's talk about banks. Many people imagine banks as giant vaults where their money sits safely until they withdraw it. In reality, banks operate quite differently. They act as intermediaries that connect people who have money with people who want to borrow it. When you deposit $1,000 into a bank account, the bank doesn't keep the full amount locked away. Instead, it may keep only a portion, perhaps $100, and lend the remaining $900 to someone else who needs a loan, maybe to buy a car or start a business. This system is known as fractional reserve banking. It works because banks assume that not everyone will withdraw their money at the same time. If too many people try to withdraw funds simultaneously, it can cause a bank run. Situations like this have occurred during financial crises, such as in 2008. Banks generate profit by lending money at higher interest rates than what they pay depositors. Essentially, they charge borrowers more for loans than they pay savers for holding money in accounts. People still choose banks for several reasons. Digital payments and transfers are easier than carrying cash. Deposits often earn small amounts of interest. And in many countries, deposits are insured up to certain limits, meaning the government guarantees your money if the bank fails. Next comes interest. Interest is the cost of borrowing money or the reward for lending it. If you borrow $1,000 and must repay $1,280, the extra $280 is interest. It represents the price of using someone else's money. There are two main types of interest: simple interest and compound interest. Simple interest is straightforward. It applies a fixed percentage to the original amount borrowed. Compound interest, however, is far more powerful. With compound interest, interest is added to the original amount, and future interest is calculated on the new total. This means interest begins earning interest. Over time, the growth accelerates. On credit cards or loans, compound interest can quickly turn small debts into large ones. Missing payments allows interest to build upon itself, making repayment increasingly difficult. But compound interest can also work in your favor when investing. A consistent return, say around 7% annually, can cause investments to double multiple times over decades. Small contributions today can grow into significant wealth over long periods. This is why interest can either become a powerful ally or a costly enemy depending on whether you are paying it or earning it. Another important concept is inflation. Inflation occurs when the purchasing power of money gradually declines over time. Your money still has the same numerical value, but it buys fewer goods and services. For example, a snack that cost 2 years ago might now cost 3 or more. The money hasn't changed, but prices have increased. Inflation can happen for several reasons. Sometimes demand increases rapidly while supply remains limited. When many buyers compete for the same products, prices rise. Other times, production costs increase due to supply chain problems, higher wages, or expensive raw materials. Expectations also play a role. If people believe prices will rise soon, they may spend more immediately, which can accelerate price increases. A small level of inflation, around 2% annually, is generally considered healthy for an economy. But when inflation rises too quickly, it can erode savings and reduce purchasing power. Central banks attempt to control inflation by adjusting interest rates. When interest rates increase, borrowing becomes more expensive. This reduces spending and slows economic activity, helping stabilize prices. Sometimes economic slowdowns go further and become recessions. A recession typically occurs when economic activity declines for at least 2 consecutive quarters or about 6 months. During a recession, businesses may reduce production, lay off workers, and delay expansion plans. Consumers also become more cautious. Instead of spending money on luxury items or vacations, people focus on essentials like food, housing, and bills. Recessions can be triggered by many factors: high interest rates, financial crises, global conflicts, pandemics, or simply the natural cycle of economic expansion and contraction. Economies tend to move in waves: growth, peak, decline, and recovery. Governments often attempt to soften recessions by lowering interest rates, increasing spending, or providing stimulus programs to encourage economic activity. Another financial concept many people encounter is the credit score. A credit score is a 3-digit number that lenders use to evaluate how trustworthy someone is with borrowed money. The typical range runs from about 300 to 850. Lower scores indicate higher risk, meaning lenders may refuse loans or charge extremely high interest rates. Higher scores signal reliability and allow borrowers to access better financial opportunities. Credit scores are calculated using several factors. Payment history is the most important, measuring whether bills are paid on time. Credit utilization examines how much of your available credit you are currently using. The length of your credit history matters as well, along with the variety of accounts you hold and how frequently you apply for new credit. Improving a credit score largely comes down to consistent habits: paying bills on time, keeping balances low, and maintaining long-standing accounts. Interestingly, having no credit history at all can still produce a low score. Lenders prefer borrowers who have demonstrated responsible borrowing in the past. Now let's step back and talk about money itself. Money might feel concrete, but in reality it functions largely because of collective belief. A paper bill or digital number has value because society agrees that it does. Governments issue currency, central banks manage monetary policy, and people use money as a medium of exchange. Without money, trade would require complicated bartering systems. However, if too much money enters circulation, inflation rises and the currency loses value. If too little money circulates, economic activity slows and people struggle to access resources. The balance between these forces helps determine economic stability. One way individuals protect their wealth from inflation is through investing. Investing means putting money into assets that have the potential to grow in value over time. Instead of simply saving money, investing allows it to generate additional returns. Common investment options include stocks, which represent ownership shares in companies. If a company grows and becomes more profitable, the value of those shares can increase. Bonds function differently. When you buy a bond, you are essentially lending money to a government or corporation. In return, they pay interest over time. Funds, such as index funds or mutual funds, combine many stocks or bonds into one investment, allowing people to diversify without selecting individual securities. Real estate is another major investment category. Property owners often earn income through rent, while the property itself may increase in value over time. Investing always involves risk. Markets rise and fall, and short-term losses are possible. But historically, long-term investing has been one of the most effective ways to grow wealth and outpace inflation. Underlying all financial success is the idea of value. Value determines what people are willing to pay for something. A plain rock has little value. A rare metal like gold has far greater value because it is scarce and desirable. In business and careers, the amount of value someone creates often determines how much income they earn. Professionals who solve important problems or provide specialized skills tend to receive higher compensation. Companies also rely heavily on perceived value. Luxury brands can charge far higher prices for products that may cost similar amounts to produce simply because customers believe they are more desirable. Understanding value helps explain why certain businesses and individuals generate enormous wealth. Finally, there is time. Time is the most powerful asset in financial growth. Everyone begins with some amount of it, but no one has unlimited supply. Many people trade time directly for money through hourly jobs or salaries. However, wealth often grows when people find ways to separate income from hours worked through investments, businesses, or assets that generate returns. Time plays a particularly important role in compound growth. Money invested today may grow slowly at first, but over decades the growth accelerates dramatically. This is why people with ordinary incomes can still accumulate significant wealth if they invest consistently and allow compound interest to work over long periods. Financial success rarely happens overnight. More often, it results from small, consistent actions repeated for many years. In the end, money itself is simply a system built on trust, incentives, and human behavior. But when you understand how taxes, banks, interest, inflation, credit, and investing operate, you gain the ability to use that system rather than be controlled by it.